Okay, recording now. It is May 31st. We're doing a test review for exam number 2. And we are just kind of going over the practice exam and any questions that you guys have. This exam 2 will cover chapters 4, chapter 5, and appendix 5A at the back of chapter 5. Okay, so chapter 4 has adjusting journal entries and closing journal entries. So in this problem on your practice exam, it says prepare closing entries. All right. So closing entries close the income statement accounts. They close the income statement accounts and they close dividends. All right. So what can we say about that? We can say this account is not an income statement account. Cash, accounts receivable, supplies. In the chat real quick, tell me what kind of accounts those are. Cash, accounts receivable, and supplies. You have 5 seconds. Yes, Michelle, I like the abbreviation. Cash, accounts receivable, and supplies are asset accounts. Casey, thank you, current assets, and Salma, current assets. Okay, we don't have any long-term investments. We don't have any property, plant, and equipment. We don't have any intangibles, and we don't have that nebulous other assets category. Accounts payable, unearned revenue, salaries payable. What kind of accounts are they? Throw it in the chat. Current liabilities, correct. They are liabilities, more specifically, they are current liabilities. And remember, liabilities only have 2 classifications, current liabilities and long-term liabilities, okay? And finally, we've got common stock and retained earnings, and those are our stockholders' equity accounts. So where you see retained earnings, if you are lucky and you get a trial balance in the proper chart of accounts order, assets, liabilities, stockholders' equity, dividends, revenue, and expenses. If you get that, all you got to do is make a line under retained earnings. Okay, that's all you got to do. You're going to be closing everything under here, dividends, revenue, and the expenses. Okay, so there's 4 journal entries required. If you have studied accounting before, you know that sometimes they can be slightly different. It can be 3 journal entries, but in this textbook, we do 4. And the journal entries are first in this, let's just pull this over here. I didn't want that. In closing the revenue accounts, if you have one, like we do in this first example, I'm going to try and do this side by side. Here you can see we have 1 revenue account. If we had 2, we'd list both of them. Revenue account, service revenue has a credit balance. To close it, we debit the revenue account and credit income summary. We only use income summary to close our books and to keep track of all the revenue and all the expenses, and then the final journal entry transfers the balance, either a debit or a credit. Should be a credit, that means we had net income. If it's a debit, it means we had net loss. Transfers it into retained earnings. The same way you've been showing it on your statement of retained earnings. Remember, statement of retained earnings, beginning balance plus net income or minus net loss minus dividends equals ending balance. Okay, so there's that first one. All these expense accounts, we get rid of them next. They have debit balances, so to clear them, we credit each expense account individually, not one big line saying expense. It has to, you have to think of it as buckets, and you have to empty each bucket individually. Credit salary expense, miscellaneous expense, supplies expense, and then you summarize all 3 of them and you debit income summary.
Professor?
Go ahead.
Hypothetically, would it also work to do like each expense in a separate like separate spot, like income summary, salary expense, income summary, miscellaneous expense, or does it all have to be together?
Typically, it's all together, Hunter. You can do it that way, but it's more work. In practice, people don't do it that way. So,
And
one
if
big
that's the case, on the test, will there be room in the boxes? Because like in the practice exam, it goes by like 3 squares. If that makes sense, there's not room to put all the expenses. On the test, will there be room?
Oh, I see like this.
Yeah.
If I do that to you, just work with it and just keep going to the next line and next line and next line. Don't worry about it. Just keep using the space that you need. I try not to do that, but occasionally I do it and it just makes students absolutely panic because they think, oh, it must only be 3 lines, and just do what you've learned how to do. So I try not to. So typically for an exam, I won't have spaces like this. I just have there's no purple. It's just one big journal entry page. Okay, good question. Because that's the sort of thing that drives students crazy. Okay, income summary. I like to show it, and you should get into the habit of saying, I don't think I put it here. Oh, wouldn't that have been nice? Okay, I didn't show it. I like to show a T account here for income summary. Just draw it in and say you had a credit on income summary. Now, after this journal entry, you have a debit. Combined, you have a $300 credit balance. So down here, we empty out income summary and we transfer that net income to retained earnings. And then our final journal entry is to clear out the balance in dividends. We had did it again. Clear out this balance in dividends, which is a $400 balance here. So clear it out with a credit and a debit to retained earnings. Okay. So let's look at the other one, which was.
One more question, Professor.
Yeah.
Are the T accounts required to like write down, or is that just to help?
It depends on the problem. I use them, but some of the problems have them, some of the problems don't. But we will not go back to doing like you guys did in Monopoly, where you book all the T accounts. I may just have 1 or 2 and say, show me what's going on in this T account.
And how do we determine if we need to use like T accounts or not?
The problem will ask you to fill out the T account, and it'll provide a T account. Okay,
Thank you.
Yeah.
Professor?
Yeah.
I'm sorry to interrupt you to the next questions, but I have 2 more questions that I would like to ask regarding the problems that we're talking about.
Go ahead.
First is for the closing entry. Is it require us to write like to close revenue account or like to close expense account? Do we require to write that?
Let me make sure I understand. Are you required to write this description here?
Yes.
No, I don't.
Okay.
We don't require descriptions for journal entries on exams.
Okay. And the next questions is for example 3, which is example 2, which is the one that we're talking about. I see that that we have net income. Is that why we credit the retained earnings?
Yeah. So you have net income of $300, which is the difference between revenue of $4,300.
Yes.
And expenses, which are $4,000.
Yes. So if we make,
go ahead.
If we make net loss, meaning that we will debit the retained earnings, right?
That's correct. Yeah, you will. You have to get rid of the balance in income summary. If it's a debit, you credit income summary and debit retained earnings.
Okay, thank you so much. And that's it.
Good questions. Okay, so here we are, same problem, exercise 10. And you guys are lucky. Once more, you have it in the right order. Only now we've got current assets, cash and accounts receivable. We've got current assets, cash and accounts receivable, property, plant, and equipment. We just have equipment and accumulated depreciation. Remember, that goes with property, plant, and equipment. Then we go to our current liabilities, accounts payable, unearned rent revenue. That's not a revenue account. That's a liability account. That's when the customer prepays us and we owe them the service or product in the future. And that adjusting journal entry that we're going to do in a few minutes, we check to make sure whether we earned any of that unearned revenue. So, and if so, we have to make a journal entry. And then we've got our stockholders' equity accounts. And now right under retained earnings, we draw a line. And everything below that line is going to get a closed. Those are the temporary accounts. Revenue is temporary, expenses are temporary, and dividends is temporary. We just use them during the current year, and we start our new year with new accounts. All right, so let's take a look here, and let's go. We're going to have the same journal entries. Hopefully I have it in here. I can't remember now, but if I don't, I'll make them up myself. Here we go. All right. So what was different about this problem, and I think what was hanging you guys up, was that retained earnings had a beginning balance, and there was some discussion of whether we closed the retained earnings account. We do not close retained earnings. Okay. Smaller. Okay. All right. Good. Okay. Now you can see we had two revenue accounts, commission revenue and rent revenue. So they both had, of course, credit balances. And then over here in the solution, we debit them and credit income summary for the $70,500. We had three expense accounts: salaries, utilities, and depreciation expense, not accumulated depreciation, but depreciation expense. They had debit balances, now we're crediting them. Now you can calculate the difference here and say we had 70,000 of revenue, but we had 70,500 of revenue, but we had 74,000 of expenses. So we had a net loss of 3,500. And that's what Michelle was asking about. We had a debit balance and income summary of $3,500. So we have to clear that out. We credit income summary and we debit retained earnings. So it works both ways. Okay. So you have to really be mindful on this journal entry. Was it net income or was it net loss? And that's why I recommend the T accounts for these kinds of journals. And then down here, retained earnings, we only take, I'm sorry, the dividend entry, we only take the 10,000, not 17,000. Okay. All right. Is that good? All right. All right. So I have adjusting journal entries, perpetual, and periodic. So which one do you guys want next? Chart of accounts. I don't think I gave you a chart of accounts on this, just to have it for your reference. Okay.
Professor?
Yeah.
Just a generic question. How similar is the practice exam to the actual exam?
It's not identical, no. But it's a good. I always tell students, don't, if you know the practice exam really backwards and forwards, you will probably pass the exam. You may not get an A, but you'll definitely pass if you really study it and know it. If your goal is an A, I would recommend you go back and review your homework questions, go back and review the PowerPoint slides, just look at the example problems in there. Make sure you're comfortable with all of them. Okay.
Are there any principles that aren't listed in the practice exam that we'd be like required to know for the actual test?
I'm not grading you on theory, so I would say I may not have put an example problem of everything that's on the homework and on the PowerPoint. So I always recommend you go back and study that as well, just to make sure you've covered everything. But it should be within those three: practice exam, homework, and PowerPoint. So once in a while, I put a little stretch question in there for you. But in general, like I said, most of the problems are, and you will have an essay on a trend analysis, but you guys know how to do that now. You know, give me an analysis of the 3-year trends, provide evidence, and in the form of numbers, and percent change and talk about the trends. So, but you guys did really well on your papers. So I think that writing is coming easier. Okay. So if you remember, there are 7 adjusting journal entries. Okay. No, Tracy, that should be on the homework or the quizzes. You know, and again, you may not have gotten a lot of those questions on the quiz because some of them it's random and there's like 30 or 40. I think you guys get a 20 question quiz or a 10 question quiz, whatever it is. There are more questions in the quiz than you got. So, okay. You're welcome. All right. So let's review those 7 adjusting journal entries really quick because they're okay. Quick question, guys. Can you see my PowerPoints? Yes or no? Okay. Yes. Thank you, Hunter.
Yes.
Thanks. Thanks, Salma. All right. So it's just 7 journal entries. So what I always tell students is go to the actual entries. 4 prepaids and 3 accruals. And the accruals could have a couple examples. It just basically means you recognize an expense or revenue. And if you recognize an expense, the other entry is going to be accounts payable or taxes payable or something like that. If you recognize revenue, you're going to most likely debit accounts receivable, credit some form of revenue, service revenue. The prepaids are 4, and they're pretty standard. So, and what I tell students is, if you are working on a problem, an adjusting journal entry problem, get the journal entry down, get the account that you debit, get the account that you credit right away. Just so in your mind you categorize, oh, this is a supply journal entry. I know that adjusting journal entry. So for supplies, adjusting journal entry is debit supplies, expense, credit supplies. Get that down right away and then work on how do you calculate it, okay? So in this problem, you're given they originally purchased or the account has a balance, no other transactions, and then end of the month, how many supplies did you have left? Not what did you spend, because that's the calculation. So it's like Friday night you had $1,550 in your wallet. Monday morning you have $800 in your wallet. How much did you spend? And of course it's the difference, right? So debit supplies expense $750, credit supplies. Okay. So let's go over and look at the practice exam real quick, right? Which question is a supply question here? 1 through 7. Which one is it?
Question 2.
Yep. Account of supplies indicates 700 are on hand. Okay. Now it's giving you the current balance before adjustments. Okay. So supplies has a current balance of $24.50, but we really only physically have 700. So you take the difference, debit supplies expense, credit supplies, and you have your answer. Okay. And it's going to be $17.50, and I show it here in the solution. Okay. All right. All right. Second journal entry. They prepaid rent for 4 months. So they had $4,400 in the prepaid rent account. Now 1 month has gone by. And you know already that this $4,400 represents 4 months. So again, debit the rent expense, credit prepaid rent, all right, for 1 month. Now let's back up here. This journal entry was debit supplies expense, credit supplies. Neither one of these entries have cash involved. I don't want to see cash in any of your adjusting journal entries because there's no cash involved in adjusting journal entries. Okay, so let's quickly look over here. Do we have a prepaid rent And by the way, it could be rent or it could be insurance. So don't get tied up if it must say rent. If it says insurance, do the same thing, but change the account titles to insurance instead of rent. Okay, so which one, if any, is our prepaid entry? What number is it? Thad, do you know the answer to this? Which one's the prepaid in this list? All right, 4. Oops, they jumped.
Oh, my bad.
What were you going to say?
I was gonna say 4.
Oh, perfect. Okay. So, and certainly you're going to say it now, right? Lock Free paid $26.40 for 12 months of insurance on June 1st. You know what your journal entry is. It's going to say insurance expense, prepaid insurance. Now you just got to figure out the dollar amount. Okay. So this represented 12 months on June 1st. And prepaid insurance $26.40. Okay, so they bought the insurance for 12 months on June 1st, and we're doing the adjusting journal entries on December 31st. Now, here's the part that's tricky. How many months have gone by between June 1st and December 31st? Michelle, you're correct. So this is what you have to remember. Now, because this test is live, feel free to ask me to put the months on the board. So, or if you forget the months, because maybe you have different names for them in your main language, don't worry. I can put the calendar up for you. That's not the problem. The problem is figuring out how much time has gone by. So June 1st to June 31st, the month of July, August, September, October, November, December. That's 7 months. Okay. So we're going to divide this number by 12 and multiply it by 7 months. Okay. And here we go. 2640 times 7/12 is 1540. Why are we doing that? Because they've used up 7 months of insurance. Okay. All right. Depreciation is a weird journal entry. We don't involve the equipment account. We use depreciation expense and accumulated depreciation. Okay, so let's look. Which problem is depreciation expense? Let's see. Which problem is depreciation expense? Bad. Yes. 3. Equipment was purchased for $70,000. The useful life is for 10 years. Depreciation is booked annually. So we've got a full year. So all we got to do is take 70,000 divided by 10, and that's your depreciation journal entry. Okay. All right. So that's 3 prepaid. Go ahead.
I'm so sorry again. because we kind of used to like seeing accumulated depreciation with like equipment, land, or building, but in this particular case, for the depreciation expense, we don't include like any equipment or okay.
So you had an original journal entry where you bought the
Yes.
equipment. And in
Okay.
my example here, I don't know if it shows up on your screen. We
Yes,
have
I
an
can see.
equipment account that we bought for $5,600. That would have been in the Chapter 3 transactions, but it's just your basic normal journal entry, not an adjusting journal entry. So when you buy a piece of equipment, you debit equipment, your assets go up, and you credit cash, your assets go down. Okay. Now, as we write off this equipment, we don't want to touch the equipment account for a very good reason, because we want to see that equipment at its original value, and then we want to compare it to its accumulated depreciation. And that gives us a rough idea of how old the asset is. Because accumulated depreciation is a permanent account. It's going to grow and grow and grow until it gets all the way to 5,600 or as close as it possible if there's salvage value. Okay. So when this asset's fully depreciated, accumulated depreciation will be $5,600 and the book value will be 0. But once a month, in this example, it's going to be 85. Debit depreciation accumulate. Okay.
Thank you so much.
Let's see, question is, do we have to write accumulated depreciation XYZ? XYZ is the name of the asset, Tracy? Yeah, you don't need to write that in. No, the homework has you do it. Accumulated depreciation building, accumulated depreciation equipment, and so forth. You don't have to do it for the exam. Okay. And then the fourth prepaid, and you can see that book value there. Okay. The fourth prepaid is a revenue one, and it involves this unearned revenue account. So we knew in this example, the company was prepaid for ad work and in advance in January, and they show they originally were prepaid $900, but they said, no, we actually we created artwork, we've earned $650. So we're gonna debit unearned revenue, which is the liability account. So that means we make it smaller, and credit service revenue, increasing our sales. Okay. So which of these problems? So look, we've got unearned revenue up here, $40,000. Which problem is an unearned revenue account problem? Which of these problems is an unearned revenue problem? Good, that's correct, Michelle. Anyone else? Yep, okay. On December 1st, Lockfree collected $40,000 for consulting services. I'm sorry, December 1st. And you can see that balance up there. Okay, that was an actual transaction, debit cash, credit unearned revenue. Now, this is a contract from December 1st to April 30th. How many months is that contract for? Direct message me. How many months is that contract for? Michelle, correct. Anyone else? Sabrina, correct. Hunter, correct. Okay. December 1st through December 31st, January, February, March. And let's look at the dates. Yeah, all the month of April. So 5-month contract. So we're going to divide 40,000 by 5, and we're going to get 8,000 a month. Okay. And this is only 1 month has passed. So we're going to look at the solutions. Where did it go? Did I get rid of it? Here we go. Unearned revenue, debit, service revenue, credit, 8,000. Okay. All right. So those are the 4 prepaids, and they're called prepaids because there was an original transaction in all of those, and that created a balance. So we had supplies, the original purchase. We had insurance, where we originally paid our insurance for the future. We had equipment where we bought the equipment and now we're depreciating it. And we had unearned revenue where the customer prepaid us. Okay. Now we've got 3 accruals. They have no original journal entry. All right. So let's look at the accruals real quick. And the easiest one is they earned this money during the month. Debit accounts receivable, credit service revenue. You were booking that journal entry back in chapter 3. We didn't tell you it was an accrual, but it is an accrual journal entry. So this one's an easy one. Okay. So we go back to, we go back here and we say, Lockfree performed consulting services. The client will be billed $4,600. Debit accounts receivable, credit service revenue. That's the easy one. The other 2 involve a note and calculating interest and salary. Okay, so here's salary. And what I want you to do is take a pencil out and draw days of the week and figure out how much salary is for each day of the week. So in this example, they say, we paid the salary on the 29th. So that's the money going out there. Okay. They won't be paid again until the next month. Can you imagine getting a monthly paycheck? That'd be awful. I get paid twice a month. So he receives total salaries, $3,600 for a 5-day work week or $180 a day. So the question always is, how much does the company owe its employees as of the cutoff date? And the cutoff date is the end of the month or the end of the year. How much do they owe them that they haven't paid them yet? In this example, the company owes 2 days. And again, you might get the salary expense wrong, but just write up the journal entries, salary, wage expense, salary, wage payable, and then work on the dollar amount. Okay. So let's look at the problem here. So we've got Lockfree pays its employees total salaries of $10,000 every Monday for a 5-day work week, Monday through Friday. On Monday, employees were paid for the week ending December 26th. So December 26th was a Friday. All employees worked the last 3 days of 2011, Monday, Tuesday, Wednesday. So they've worked 3 days, but they haven't been paid for them as of the cutoff date. So that's going to be $2,000 a day times 3 days is $6,000. And you can see it right here. It should say salary and wage expense, salary and wages payable. Okay. All right. And then the last one is interest. Any questions on salary? Let me back up. Do you guys have any questions on the salary journal entry?
Yes, I do.
Yeah.
I see that you mentioned, like, do we need to write like salary and then wages expense, or we can just pick one of them and then write it?
You can pick one of them, but if the problem says wages and you say salary expense, then you get it wrong. Salary and wages expense covers you. So I'll leave it to you to decide, but I would say you're safer doing both.
Okay, thank you so much.
All right. All right, so here we have kind of a busy slide. So we have, and again, back in chapter 3, they signed a 1-year note for $5,000 and they're accruing the interest on this note. Okay, it is a 3-month note payable. Don't get hung up on the 3 months. The interest rate is going to be annual, and that's what you need to know. So 5,000 times 12%. I don't show it here, but that's $600 divided by 12 is $50 per month. Okay, and now you've got your number. And in my example, it was only for 1 month. If it were for more months, you'd say 50 times 2 or 50 times 3. All right, so here's your journal entry. Again, you may have trouble coming up with the dollar amount, but get that journal entry down. So let's look at the problem real quick. And we've got a note. Lockfree borrowed $20,000 by signing a 12% 1-year note on September 1st. No adjustments been made. It's now December 31st. How many months have gone by? Put it in the chat. Good, Michelle. Anybody else? How many months have gone by between September 1st and end of the year, 12/31? Selma, correct. So it's going to be 4 months, not 5, 4 months. September 1st to September 30th, 1 month. October, November, December. Okay. And make no mistake, you guys are in accounting 201. Everybody makes mistakes in counting off months. You could have a CPA and you'd still have trouble with the months. So always kind of double check on your months. Everybody does that. All right. So 20,000 times 12% is going to be $2,400 for a year. So that's $200 a year times 5. I did my math correctly. We're going to have interest expense, interest payable. Did I say 4 months? Did I screw that up? Yeah, no, it's 4 months. It's 4 months. Whew. All of a sudden I thought it was 5. Interest expense, interest payable, $2,400 divided by 12 is $200 times 4 is $800. Okay, so get those entries down. All right. Questions on that one? So interest expense and salary expense are probably the most complex. If you get stuck, just get that journal entry there and you will get half credit. All right. Okay. So that takes care of adjusting journal entries. And now for perpetual and periodic, let's do a cheat sheet on that one. And so chapter 5 is packed. You've got the multi-step income statement you need to know for perpetual. Let's review that really quick. I know we went over that, I think, last week. I want to show you. Okay, so this is for a perpetual. How do I know that it's for perpetual? There's a great big clue here. I have one line that says cost of goods sold. That's it. For periodic, I've got to do that 5-step calculation for cost of goods sold. All right, and we talked about that last week. Beginning inventory plus purchases minus purchase returns, not sales returns, purchase returns, minus purchase allowance plus freight equals goods available for sale minus ending inventory equals cost of goods sold. But here with perpetual, I'm tracking cost of goods sold perpetually. I'm tracking inventory perpetually. So we have three big subtotals here. Net sales, if you have more than one sales account, gross margin, difference between net sales and cost of goods sold, income from operations, the difference between gross margin and total operating expenses. And then at the bottom, we have other revenue and gains. We add these. Other expenses and losses, we subtract these. So that 700 is a net add. So income before tax, 20,978. Income tax expense will be provided to you as a percentage, and you'll calculate it against income before tax to get net income. Okay. All right. We're not going to do a single step, and then periodic. Here's all the journal entries. This presentation, you really don't need all this detail. I'm more interested in, do you know how to calculate cost of goods sold? So let's look at this. The numbers I really care about is that one, beginning inventory, purchases, 143,900 minus 11,200 minus 2654 plus freight equals cost of goods purchased. Don't forget to add your beginning inventory. That's your goods available for sale. Oops, sorry. Minus your ending inventory is your cost of goods sold. Okay. But what I wanted to show you here was this slide. There's two slides here that are super helpful, and it's a side-by-side comparison of the perpetual journal entries and the periodic journal entries. And for some reason, I have a whole extra I there. Okay. So I'm going to give you permission to use the account inventory or merchandise inventory. They are the same thing. Whichever account you use, be consistent. If you use inventory, don't have merchandise inventory in another transaction. You want to be consistent. Okay. So purchase, debit inventory, credit accounts payable, freight in, debit inventory, credit cash, returns, you're just reversing your first journal entry, debit accounts payable, credit inventory, and then your prompt payment, debit accounts payable in full for what you owe. And then merchandise inventory is whatever amount that discount is for prompt payment. And then the difference is cash. So the actual cash, when you get a discount, you pay less. And that difference goes to the cost of inventory. And so your inventory cost is 1,400 plus 140 minus 130 minus 25. However, if we're doing periodic, we just go purchases, not inventory, because we don't know what inventory is, because we haven't counted it. In the perpetual system, we actually know what's in inventory. There can be mistakes here and there, but in general, the computer's tracking every item all the time. What comes in, what's sold. These accounts in green that you see here, purchases, freight in, purchase returns and allowances, purchase discounts, they are temporary accounts. Until we count inventory, we don't know what cost of goods sold is, and we don't know what ending inventory is. So debit purchases, debit freight in, credit purchase returns and allowances, credit purchase discounts. The items in black are the same, whether it's perpetual or periodic. So these are the purchase transactions. Now we've got perpetual. Okay. Perpetual inventory, this part is the same, but here we track cost of goods sold, debit, and inventory going out. I abbreviated merchandise here. Okay. Sales returns and allowances, that's a new account for Chapter 5. That's when a customer returns something. We don't debit sales. We debit sales returns and allowances because we want to know. Again, it's like the equipment and accumulated depreciation. We want to know the difference between our gross sales and what was returned. And we feel that way about the sales discounts too. We want to track those separately. Okay. So you'll notice that for both the sales transaction, it's a 4-line journal entry. And for the return transaction, it's a 4-line journal entry. And that becomes pretty important because what are you doing here? You know this part, accounts receivable, sales. Because it's merchandise, we use sales for the revenue account. If it were service, we'd say service revenue. Here we're debiting cost of goods sold because we're saying we had a cost, and you can see how cost is less than the sales amount. That should make sense to you, right? You buy at one price and you sell at a higher. And we want to take the inventory out of the inventory account. Okay. Here's the return. Now we're putting the inventory back in. The customer returned the inventory. Now, if the inventory is damaged, there will be separate process to deal with that and write that off as scrap or damaged inventory. We don't go into that in here, but if you go on in accounting, you'll get that. But let's just assume they didn't like it and they just want to return it. So we put it back in the inventory with a debit and we credit cost of goods sold. And then down here, debit cash, debit sales discounts, credit accounts receivable. That's the same whether it's perpetual or periodic. And you can see that's the same. Over here, the journal entry is straightforward. There's just no entry for cost of goods sold. Okay. All right, Michelle has a question on the previous slide, the purchases. Go ahead.
So toward the perpetual system on February 14, I see that the order for the journal entries is account payable, cash, and then inventory. But in the quiz answer, I saw that the order kind of switch up a little bit. So instead of account payable, cash, then inventory, it says account payable, inventory, and cash. So I wonder, will that order affect?
Here?
Yes, yes.
Doesn't matter.
Okay.
I
Thank you.
know with Wiley Plus, sometimes they get really picky, but I don't. And
Okay.
no computer should ding you for order on the credits. They don't usually do that, but I don't know if Wiley Plus did that.
Okay, thank you.
You bet. Yeah. All right. So pretty straightforward. Something else you guys need to know about, going back to the multi-step income statement here. Freight out. Okay, that I actually remember as a student just struggling so much with freight in and freight out. Freight in is when you buy inventory. The company buys inventory. They're going to turn around and resell it, you know, like a Walmart. They buy 100 polo shirts. They're going to turn around. The freight in goes into the merchandise inventory cost because inventory, the cost that goes into inventory is all the costs that get the inventory ready to be sold. So of course, if you buy inventory from a company, let's say Columbia Sportswear, of course, if the terms are FOB shipping point, it means the buyer owns it at the shipping point. So they're going to have to pay the freight bill. So if you have that situation, the freight in goes in perpetual, you're just going to debit inventory for the freight in cost. In periodic, you're going to call it freight in, but eventually it goes into cost of goods sold. Freight out is when the company sells to another customer and they ship to them. If the company pays it the freight bill, they'll debit freight out expense and credit cash. And it goes under operating expenses. Freight out is definitely an operating expense. It's part of the cost that it took to sell their products to a customer. Okay, so just want to make that point. Sometimes students get confused in those two things. All right. So here we had, I don't have a freight out transaction here. I don't show it because in this example, the buyer paid the freight. But if the seller paid the freight, you would see another transaction here, freight out and cash. Okay, so just read the problem. If it's FOB shipping point, the buyer pays the freight. If it's FOB destination, the buyer doesn't own it while it's being shipped. The buyer owns it when it arrives at their own company. So the seller has to pay the freight. Okay, so that's perpetual and periodic, and I demonstrate cost of goods sold here. All right. All right. So let's take a quick look at, sure, we'll save that. Let's take a quick look at the practice exam and see if there's any particular questions on perpetual and periodic that you guys have. All right. So let's look. A lot of closing journal entries. Here we go. Exercise 3. Kai Construction is a company and they use perpetual. So when you approach these problems, your first question is perpetual or periodic. Okay, you just have to know that. And you can see in this problem, we have purchase transactions, we have a purchase returns, we have a payment, and then we have the same company selling. So we're looking at both sides here, okay? And they sold them to Kraft, and Kraft returned some. So they've got a sales return. And then Kai receives a freight bill for shipping to Kraft and pays it, okay? Now, if Kai is selling to Kraft and Kai pays the freight bill, the freight terms have to be FOB destination, okay? All right. Did anybody have challenges with that one? And then the next one is a periodic. Martinez orders doors. Martinez takes delivery. Kraft purchased doors. Martinez receives an allowance. Kraft returns. So Kraft is their customer. And sometimes with these problems, it might be helpful to on the side of your paper to write company equals Kai. So hold on, Martinez, back up. Company equals Martinez. Kraft equals customer. Okay. Seattle Doorhouse equals supplier or vendor. Okay. So I always like to look at it like a stream. So we're doing the books for Martinez. So Martinez is in the middle. So Seattle Door sells to, can you see this sheet, this Word document? No, to Kraft. Well, okay. So because we're doing Martinez, because the company is Martinez that we're doing the journal entries, the books for, in this case, we say vendor, company, customer. So get that right in your head, because when you're doing these journal entries, you need to know which way is up. Which way are we doing this? Okay. So company places the order. That's a purchase transaction. Company takes delivery of the doors. That's a purchase transaction. And then because of the way I've worded this, Craft purchased doors, it's the customer, but I didn't say Martinez sells to Craft. You have to read the whole sentence and realize, oh, Martinez sold to Craft. Martinez receives an allowances for the doors, purchase returns and allowances. In this case, there was no return. And then Craft returns one door and pays its invoice. And you could do this as one transaction or two. End of month inventory is 16,129, and that's where we do the adjustment for calculating cost of goods sold. Okay. All right. So we are just about out of time. Does anybody, I think I've covered everything except a quiz question. Michelle, what was
I had a quick question.
Oh, Shira, go ahead.
Sorry, I just had a quick question for the second line where it says Martinez takes delivery. How would you do the entry for that?
Okay, so Martinez placed an order from Seattle's Door House. Okay, so going back to chapter 3, where I asked you guys, was there an economic exchange? If so, you do a journal entry. Placing an order is not an economic exchange. Okay, if Seattle Door House shipped to them, that would be one thing, but they didn't. They just received the order. So if we look at the solution, I'm pretty sure it should say no entry. Let's make sure of that. Exercise 4. Exercise. No entry. Yeah. Okay, this is because there was no exchange. It just, I mean, think about the company Boeing, Shira, where you might have a huge backlog of orders and they don't get to call it revenue until they actually ship the order. Okay, so Martinez placed an order, but nothing has happened yet. Now Martinez takes delivery. Now we say purchases accounts payable. Okay. And then
Okay, so when you say like takes delivery, it just means like they got the inventory.
correct.
Okay, got it.
We could also say, Shira, we could also say Seattle's Door House ships order to Martinez, FOB shipping point. If you saw that language,
Oh,
you would also make this journal entry. So it could be worded, let's see, Seattle Door House ships to Martinez. Okay. And the reason for that is if the terms were FOB shipping point, then the buyer has to book that order at the point of shipment. Okay, they have to
Got
book it. They own it. Okay. Now, in practicality, they don't usually do that, but for end of the year, they save all the invoices that come in the first week or two, and then they make an adjusting journal entry and say, if this shipped before year end, we have to book an adjusting journal entry. Okay. All right. Any other questions? All right. Well, I wish you guys luck. I will be in my office hours tomorrow morning at 9:20. So if you have any last minute questions, and then I will see you guys either at, let's see, did everybody sign up for the exam? Boy, I hope so. We'll find out, right? Yes, everybody did. All right. So everybody's in, and I will see you at 1 o'clock or at 3:10. And, you know, bring snacks, bring a drink if that helps, but don't drink too much. And I'll see you tomorrow. Have a good one.
Thank you,
Thank you.
Professor.
Bye-bye.